Hi, and welcome back to Money Talks. I'm Susan Warnick, and my guests are from Finer Wealth Management, to my immediate right, Mike Finer, and to his right, Gary Kuhn, the principals at Finer Wealth Management. It's great to see you guys, as always.
Great to see you too, Susan.
We are going to spend the next 15 or so minutes talking about taxes. People who are watching this at the end of 2015, I know, are very interested in their last-minute write-offs. My birthday, by the way, is December 31st, and I remembered my whole life my father telling me what a good thing that was. So if you're having a baby, let's hope that it's by December 31st. That's obvious. But also some things that people need to know for 2016. But let's start with right now. What can people do to help themselves now, before the end of the year, on taxes?
Well, one of the most important things that people are asking about now relate to charitable contributions.
Mm-hmm.
So with a few weeks left in 2015, or at any year-end time, there are a lot of options with regard to making charitable donations. One of them can be obviously just sending a check to a charity, before year-end, or cash. Another is donating the physical property.
Can I just stop you right there?
Sure.
Because from my years of doing investigative consumer reports, what I want people to be clear about is that if you do donate to a charity, donate directly to the charity and not to one of the telemarketers who's calling you, or not to respond to just something you're getting in the mail from a telemarketer, because chances are that most of your money is not going directly to the charity. So that's kind of important for people to know, to donate directly to the American Cancer Society, for example. Call them, get their address.
Yeah, sure.
And
that's an excellent point.
100% of what you donate is tax deductible?
Generally, if you are doing it to a 501c3 public charity, 100% is tax deductible. But let's talk for a minute about what does tax deductible mean, because people are confused often by the word tax deductible. So if you donate $100 to a public charity, let's just say the Red Cross, just for argument's sake, a tax deduction means that you can take $100 off of the amount of income that you have for the year. So if you made $10,000 for the year and you donated $100, you now have $9,900 that you'll be taxed on. And if your tax bracket is at 10%, that means the $100 that you just donated saved you $10. It doesn't mean that you can subtract $100 off of your taxes that you owe to the IRS. You wish you could. If that were the case, charities would be getting everything instead of probably the government.
And there's also a ceiling as to how much you can donate.
There is. There's a ceiling for public charities generally of 50% of your income, and to non-public charities can either be 20 to 30% of your income.
What's a non-public charity?
What we call private foundations and things like that. So in the news this week, in fact, was Mark Zuckerberg and his wife had a baby and are setting up a charity. I think the charity is going to be what we call a foundation, not a public charity. So a foundation is where a small group of individuals set up a charity, and the funding comes just from a very small group of people, versus a public charity, the funding comes from a large group of people. And when you donate to a public charity, you can take up to 50% of your income. If you donate to a private charity, like probably the Zuckerberg charity, or maybe like the Bill Gates and Melinda Gates Foundation, anything with a foundation in it probably means you can't donate. You donate either 20 or 30% depending on the configuration.
What about political contributions?
People do make those, but that's not considered a...
Well, at one time, I mean, the laws have really changed. At one time, you could deduct the amount of interest that you paid on a credit card, and you can't do that anymore, right?
Yeah, I mean, despite the fact that there's the rhetoric of the tax code being thousands of pages, which it is, they've really clamped down on the number of deductions for the individual. Mortgage interest is limited. Charitable contributions and the type are limited in different ways. As you mentioned, it used to be that you could deduct every type of interest with no limit. Now, poor consumers who have what we call personal interest, which is credit card interest, personal loans, even interest on cars and auto, are no longer deductible unless they actually can relate to a business. So it really is anti-consumer and anti-individual in many ways.
And Gary, from your vantage point, what do you think some of the great confusion is for consumers?
Well, I think going to your first point about being careful about the charities, you know, the organizations you contribute to, I think one of the things that comes to mind with respect to that issue is I really believe strongly that just like your investments, you should have a plan, financial planning in general. That relates to taxes as well. And I think if you're, as we tape, obviously we're near the end of the year, and you, if you do want to make those contributions, you have a few weeks left, but you would have more time to really investigate and make sure your money's going to the right place, and even think through just philosophically what kinds of organizations you want to support if you kind of think that through earlier in the year. So,
So that's a good thing to do for 2016.
Yeah, maybe start that process a little earlier and think that through, so you make sure that your money's going to where you think it should be going, and you're getting the tax benefits of it at the same time.
So you figure out, the first thing is how much you have to give?
Right.
And how do you figure that out?
Well, obviously there's, you know, people have different philosophies about that, whether you have, you know, you think of the world of tithing as 10%, you know, well, maybe
of your
not
gross income?
Yeah, but not everybody's going to be in a position to do that. So I think it's sort of what you feel that based on your budget, you can give to other organizations, whether it be, you know, religious, political, even though it's non-deductible. Some people, you know, want to, that's important to them, and the charitable organizations. So beginning of the year is a good time to think through that, because, you know, people think of, you know, their New Year's resolutions. You know, what's my year going to likely look like financially, to the extent I can plan for that. And then if I want to feel like I can carve out a piece for those contributions, you know, really think that through and make sure your money's going to the right place throughout the year. The second thought I have, just sort of wearing my investment hat, is that there's certain retirement plans that if you want to make sure you get the proper tax benefit to making contributions to those retirement plans, you need to do them by the end of the year. There's other retirement plans that you have until your taxes are filed next year. So, you know, so I think, you know, that's where we kind of help people look at, okay, what are the different plans you have? And again, if you're starting at the beginning of the year, obviously now in December, if you're in one of those plans, you should be, if you haven't already, contributing if you can. But starting fresh next year is to look at what you have in terms of retirement plans and find out, make sure you don't miss the opportunity at the appropriate point in the year to make those contributions. We also have, there are required distributions that some individuals have to make from their retirement plans based on reaching a certain age, and those have to come by December 31st. In most cases.
And what are the penalties if you don't?
And penalties if you don't make it. And,
pretty
you know,
stiff
so
penalties.
yeah, so that's that's important to make sure that we help calculate on when we're working with clients, we help calculate that so that we can make sure we get that what the IRS is expecting. And
but not more than
but
you
not
need.
more.
Exactly.
There's a formula and there's charts that you follow, and but again, that if it's required for that individual, that needs to be done in most cases by the end of the calendar year. Nice to not be waiting until December to do that. And so, and as Mike can speak to, throughout the year, there's sort of different seasons to what taxes need to be paid, what kind of contributions and when you make them so that you can get the full benefit. And with your investments, there's different timing. And obviously if you own a small business, there's other issues that come to play. So that's why I kind of go back to, it's really helpful to really think through a plan for your taxes that's tailored to your situation. And again, I think the idea of doing something and sort of putting that plan together at the beginning of the year is really a better time to do it.
We're going to do an entire show explaining to people the different experts in the field of money management and all that, but it does seem like this is an appropriate time to talk about why it's really good to have your own personal CFO, you know. And a lot of people go to some of the big chains that prepare taxes, which can be perfect for a lot of people. but who just don't want to do it themselves. But you really should have somebody who knows what they're doing.
There certainly is a spectrum in a continuum of preparers and financial advisors, all the way starting from someone who do it yourself, and there are some people who are able to certainly do it yourself, all the way to the other end of the range of sort of personal CFOs like we are, where we generally take care of all the services, whether it's investment, tax, financial planning, bill paying for people. So in that respect, it depends on partially on the complexity of your situation. You generally want to get the group who has the most expertise for your particular needs and who have specialists who can deal with the individual pieces of your situation, because everyone's different. You know, as an example, we've talked a lot here about charity, so you really need a tax person who is with you throughout the year, not just going to prepare the return reactively after the fact, who can help guide you through the fact. Let's say you want to donate a car to a charity. You may do that and not have done everything properly, so that by the time H&R Block has done the return in the next year, you may not have maximized everything properly.
And like you said, alluding to donating a car, and he did that, folks, because I did donate a car to the BLB orphanage in Haiti, which I'm on the board, and it's very close to me, and they need my Jeep. And so they got my Jeep. But there are a lot of charities that just say donate your car, and they're not taking your car per se, they're taking the parts for the car, and you're not getting the value of what you think you're getting. And so that's another thing that you need to really be careful about, and you need an expert to be able to tell you that.
If you think about just donating a car or any asset, you have to do several different things. First of all, you have to, as you mentioned before, donate it to an actual charity. And the IRS has a list online that can help you with that, just to make sure if it's questionable. So you have to donate to the appropriate charity. And then your donation is generally based on a complex set of ideas, most of which is, what is the fair market value of the vehicle? And the fair market value can be subjective and questioned.
Oh, absolutely.
The IRS may not agree, you know, in the regulations as to what the fair market value is versus someone who's giving you an appraisal or Kelley Blue Book or whatnot, so you have to establish the fair market value. Then you have to have a bunch of documentation to submit with your tax return to get the tax deduction.
I got nothing.
Well, we, of course, being
We'll
on
have
the
to
board
talk
of the
about
charity,
that,
yes,
won't we?
we will get all the
I
appropriate
got a hug.
documentation.
I got a big
Yeah.
hug.
I'm sure you got a big hug, but
Did.
the documentation will be the you know, appraisal of the vehicle, you know, and sign the forms that are necessary to establish the value of the vehicle to include with the tax return. But that, you know, it's based on value too of what you have to include with
Right,
the tax
and the point
return.
is that you need to
The
have an
point is-
expert and a plan and
Sure.
understand why you're donating the car
Sure.
and what you're going
So-
to get for it.
Yeah, and that's just one piece. So you're donating it out of the goodness of your heart, obviously. It also is part of your tax planning, which is also part of your financial planning to figure out what you get to keep, part of your cash flow, and part of your overall wealth management. And all of those pieces are fully integrated without question.
We're out of time. Do you get 15 seconds you want to add?
Just education, just as another example, obviously people with kids may be time to think about how that ties into their tax planning as well, saving for college and different plans available that may have a tax benefit
That are
to
written
them.
specifically for that,
Right.
actually. So, well, unfortunately, we are out of time.
Well, I just want to say that if you had been born on January 1st, you
My
still
father wouldn't have loved me as much.
Now,
Well, he probably
though,
would've, but-
I'm not sure when, you know, then, but now you actually can get the tax deduction in the previous year.
Oh,
They do it so they don't want people having babies, you know, pushing out right at the last minute. So it's an interesting fact. Yeah.
it's very interesting.
So
Yeah, if not personally valuable.
yes, just in case, just in
Thank
case
you.
for you.
Mike Finer, Gary Kuhn from Finer Wealth Management. Until the next time, thanks for joining us.